The current market is closed as of Saturday, December 20th, 2025, and NVIDIA Corp closed its last active trading session on Friday at exactly $180.99 USD per share, marking a significant intraday climb of $6.85 or 3.93%. While many retail traders are looking at this percentage jump as just another green day in a long line of rallies, the real story lies in the massive volume shift that occurred in the final hour of trading. Most people think NVIDIA is simply riding the wave of high demand for chips, but the reality is that we are seeing a structural shift in how institutional portfolios are being reweighted as we approach the end of the year. While the common belief is that the easy gains in this sector are over, the current price action suggests that the big players are actually digging in for a much longer cycle than the public anticipates. If you have been keeping an eye on your individual brokerage account lately, you might have noticed that NVIDIA stock has been behaving differently than it did during the parabolic runs of the previous year. Most of the market expects a massive pullback because the valuation seems stretched, but what is actually happening is a consolidation of power. Instead of a bubble ready to burst, we are seeing the stock transition into a foundational utility of the modern economy. When you look at the recent trading data from the Fidelity trading platform or the Interactive Brokers platform, you see a clear pattern of institutional accumulation whenever the price dips below the $175 mark. This suggests that the floor for this stock has moved significantly higher, catching many short sellers off guard. The general sentiment among retail investors using the Robinhood app or SoFi Investing is often focused on the next big headline, but the professionals are watching the supply chain metrics. There is a persistent expectation that competition from other chip makers will eventually eat into the margins of this giant. However, the reality is that the lead in software integration is proving to be a much bigger moat than the hardware itself. People often compare this to the early days of mobile phones, but a better comparison would be the build-out of the electrical grid. You do not just swap out the foundation once it is laid, and right now, this company is the foundation. Looking at the daily swings we saw this week, the volume was nearly 20% higher than the 30-day average. This kind of activity usually precedes a major announcement or a significant shift in sector momentum. While the S&P 500 has been relatively flat, the semiconductor space has been decoupled from the broader market. This tells us that investors are no longer treating these stocks as mere tech plays. They are treating them as a separate asset class. If you are doing your own self-investing through an Interactive Brokers account or a Fidelity brokerage, you have to look past the daily noise and see where the large blocks of shares are moving. Institutional activity shows that the largest hedge funds are not selling. They are actually using sophisticated tools like Schwab Intelligent Portfolios or other automated systems to maintain their weightings. The recent earnings reaction was another case where expectation did not match reality. The street expected a beat, but they also expected a conservative guide for the next quarter. When the company instead signaled that demand for the next generation of hardware is already outstripping production capacity for the next 18 months, it forced a massive revaluation. This is why we saw the stock jump nearly 4% today, even without a specific news catalyst. It is the realization that the runway is much longer than anyone dared to hope. For those using Robinhood stock trading or SoFi active investing, this kind of stability in a high-growth name is rare. It provides a level of comfort that usually only comes with older, slower companies. Comment below how many shares of NVIDIA Corp you currently hold in your portfolio right now. I want to see how the community is positioned as we head into the new year, and if you are leaning more toward growth or stability in your current strategy. When we talk about the business model, it is important to understand that this is no longer just a company that sells parts to gamers. They have effectively captured the entire stack of high-performance computing. From the physical hardware to the libraries that developers use to build their programs, they have created a closed loop that is incredibly difficult to leave. This is why wealth management firms and those providing investment help are often keeping a high allocation here, despite the high price. They see the recurring value of the ecosystem. It is similar to how Apple stock became a staple because of its services and ecosystem, not just because it sold a nice phone. In the past, we saw massive volatility because the company was dependent on the gaming cycle. Today, that part of the business is almost a side project compared to the data center revenue. We are seeing a shift where every major corporation is essentially forced to become a tech company, and to do that, they need the specific processing power that only one, or most efficiently one company provides. If you are looking at investing sites or using a Fidelity mobile app to track your progress, you will see that the sector momentum is being driven by this single entity. It has reached a point where it dictates the health of the entire Nasdaq. For those who are interested in online investing through platforms like SoFi Invest or Robinhood Investments, it is worth looking at the macroeconomic pressures. Inflation has cooled and interest rates are starting to find a level that doesn't stifle growth. This environment is perfect for companies with high margins and plenty of cash on hand. They can afford to outspend any newcomer, effectively buying their way into any new market they want to dominate. This is why the institutional owners are so comfortable holding through the dips. They know that the reality of the cash flow is much stronger than the expectation of a cyclical downturn. Past performance is not always a guarantee, but the historical trend of this company showing up exactly where the market is going is hard to ignore. They moved from graphics to data centers and then to the specific type of computing needed for modern intelligence tasks. Each time the market thought they were overextending, and each time the reality was that they were just ahead of the curve. This is a common theme in high-level investing. The smart person often looks like a dreamer until the rest of the world catches up and realizes they were just looking at the data more clearly. Looking ahead, there are several catalysts that could push the price toward the $200 level. The rollout of the latest architecture is just beginning, and we haven't even seen the full impact on the bottom line yet. Furthermore, the expansion into automotive and healthcare sectors provides a massive secondary market that is currently underappreciated by the general public. If you are managing your own Fidelity IRAs or using a SoFi robo-advisor, you might want to check how much exposure you have to these specific subsectors. The growth there is slower but much more predictable. The risks are always present, of course. Geopolitical tensions can disrupt supply chains, and any sign of a slowdown in cloud spending would be a major red flag. However, current data from the Interactive Brokers trading platform shows that the buy orders are still outweighing the sell orders by a significant margin. This suggests that the market is more afraid of missing out on the next leg up than it is of a potential correction. It's a classic battle between the fear of a bubble and the reality of a fundamental shift in the global economy. If you are using Robinhood fractional shares or other tools for online investment, you have a unique advantage to build a position over time without needing to time the market perfectly. This strategy of self-investing allows you to benefit from the long-term trend while ignoring the daily fluctuations that cause so much stress for short-term traders. Whether you are using Fidelity mutual funds or picking individual stocks on the Interactive Brokers platform, the goal is the same: to find high-quality assets that the market is mispricing based on a misunderstanding of their future potential. In summary, the movement we saw today with the stock closing at $180.99 is a clear signal that the market is beginning to price in a much more stable and long-term growth path than previously expected. The contrast between the expectation of a volatile, hype-driven stock and the reality of a steady, infrastructure-based powerhouse is becoming more obvious every day. We have seen institutional activity increase, trading volumes remain healthy, and the company's fundamental position in the market become more secure. The central insight here is that you cannot judge a company like this by the standards of the past. The demand for high-performance computing is not a trend, it is the new baseline for how the world functions. As long as the reality of the earnings continues to exceed the expectations of the skeptics, there is a strong case for continued strength. You have to be willing to look at the deeper data and understand the structural changes happening in the tech world. It is about more than just chips. It is about who owns the architecture of the future. Whether you are using Fidelity Wealth Management for a hands-off approach or you are an active trader on the Robinhood app, staying informed on these shifts is the only way to navigate the current market effectively. The era of blind growth is being replaced by a more disciplined approach to investing, where quality and market dominance are the most important factors. Make sure you are paying attention to the signals, not just the noise, as we move into the final weeks of the year. As we wrap up this analysis, remember that the market is always a reflection of human psychology as much as it is of math. The tension between what we expect to happen and what is actually happening on the ground creates the opportunities that make investing so rewarding. Keep your eye on the intraday movements, but never lose sight of the bigger picture. This stock has proven time and again that it can defy the odds, and the current setup suggests it might be preparing to do so once more. The authority of your analysis comes from your ability to see through the common narratives and find the truth in the numbers. When you use tools like an intelligent portfolio or a sophisticated individual broker